Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is about buying your first home with very little money. When you decide to buy your first home, it isn't an easy step, especially because the Canadian real estate market has gone crazy through the last year or the last 10 years. It's hard for me to believe the rental properties that Erwin and I bought together last year had gone up as much as $350,000 in a matter of roughly half a year span. Whether this type of increase is sustainable or not, as a parent, I feel the pain for our next generation, the people who are trying to get into the market, the very first home that they're trying to buy. So today, I'm going to go through a few steps that can help the next generation or the people, whoever that are interested in buying their first home, to illustrate how I get to purchase my first home and the government programs that are available to help these generation to purchase their first home. Every week, I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. If you have any other ideas or experience getting your first home, by all means, leave them in the comment section below so that we can all share and we can all help each other. I'm extremely grateful I got my first home over 10 years ago. I was lucky to be born when I was born. My first home was a one-bedroom condo located in Richmond Hill, Ontario. It was a great little place at the time for me, single person at the time, one-bedroom condo. I remember that I had aggressively saved up for my down payment, my initial down payment, borrow against my RRSP, and leverage almost all the government tax credit I could find. It wasn't easy, but I made it through. I thought it was tough at the time. It's even more challenging today, seeing the young employees who are struggling to get their first home. I want to summarize all the tips and tricks that I can see in the marketplace to help those who are interested in buying their first home to get a head start. Now, first thing is aggressive saving plan for down payment. How do you get your first down payment to buy your first home? Generally, when you are going to buy a house or your first home, the first thing you need is a down payment and money for upfront costs. Now, if you are a real estate investor to begin with, you may have the cash you need to purchase your first home. However, if you are just starting out, investing in your first property, or if you are in your 20s and this is your first home that you're buying, then you may need some help. Your down payment cash can come from aggressive savings you have been setting aside for the purchase of a home, and perhaps you have open RRSP or TFSA, which lets you save or invest your money tax-free. And yes, these funds in your registered accounts can help you buy a home, which we will go into details. Savings are much easier if you set it up as autopilot. From my personal experience, it took me years to grasp this concept. I set up an auto deposit to my TFSA account on the day I get paid. I have a TFSA account with a different bank, which means that I don't get to see the balance on a regular basis. So the saving actually got deducted from my cash account, my regular checking account, and it get deposited to a different banking institution that I don't log into on a regular basis. So the money I save actually got removed. And so when I log into my regular saving account, I don't see the saving that I put into a different TFSA account in a different banking institution. The saying that goes out of sight, out of mind is applicable to money as well. Once the money is gone from one bank to another that you don't get to see all the time, you'll be surprised when you find out how much you have saved up at the end of the year. However, housing market prices are skyrocketing, and if you haven't begun saving up already, you could consider some family help. Such as a gift from your parents, perhaps. According to a CIBC study, parents are giving on average $82,000 to the first-time home buyers to assist them with the down payments. This amount is even higher in GTA. Get as much help as possible to get your life started. For the parents out there, be prepared. This problem is just going to get worse. You may need to even give more than $82,000 in the future. Another option to help you to buy your first home is to partner up with friends and family members to buy your first home. Now, if you still can't afford a house on your own, you don't have much help from your parents, your down payment is not sufficient, this may be an option to you. You could consider buying a property with a family member or a friend. Your share of the down payment is lower and your share of the mortgage payment is also lower. Your other expenses will go down too because you then share the cost of the property taxes, heat, electricity, internet, and all other utilities with your co-owner. Additionally, sharing meal costs will decrease your food costs as well. Now, the third idea that I came up with is house hacking. House hacking can help you qualify for a bigger mortgage and make your home more affordable. What is house hacking? If you don't have enough income to qualify for financing, another way to potentially supplement your income is by renting out a portion of your home. By renting out a portion of the house, you now earn extra income, which helps to cover a bigger mortgage and all the expenses that you have with the house. And Canada Mortgage and Housing Corporation, we will call it CMHC later on, is a government agency that has a mandate to improve Canadians' accessibility to housing, recognizes the rental income you are expecting to receive. So CMHC, the government agency, actually recognizes the rental income that you are receiving from house hacking. This can potentially help you qualify for a bigger mortgage. You can find out more about the program in the link above. As a first-time home buyer, you can take advantage of the government's help using the first-time home buyer incentive plan. As a first-time buyer, you can even get land transfer tax credit. You may even be able to borrow from your RRSP or HBP plan. Okay, let's discuss each of this program in detail. The first program available is called the First-Time Home Buyer Incentive Plan, which is administered by CMHC, also known as partnering up with the government on the purchase of your own home. Simply explaining, the government through CMHC lends buyers or first-time home buyers either 5% or 10% of their house's purchase price to put toward their down payment toward the purchase of their first home. Depending on the type of homes that you are purchasing, CMHC lends you either 5% or 10% of your down payment. For example, for a first-time home buyers purchasing a newly constructed home, so brand new home or brand new condo, you can get either 5% or 10% from CMHC. For a resale home or an existing home, or a new or resale mobile or manufactured home, CMHC is going to lend you only 5%. By participating in this program, qualified first-time buyers can reduce their monthly mortgage payments as the government is chipping in for 5% or 10% of their purchase price. So you're reducing your financial burden on a monthly basis. It is basically a share equity mortgage with the government of Canada. You can read more about this on this link above. How would you qualify for this program? To qualify, you need to have total annual qualifying income less than $120,000. $150,000 if the home you're purchasing is in Toronto, Vancouver, or Victoria, because the homes there are the most expensive in the country, so you get to have a higher qualifying income. Total borrowing cannot be greater than 4 times your qualifying income. So if your qualifying income is $150,000, the total borrowing cannot exceed $600,000. If your home is in Toronto, Vancouver, or Victoria, it cannot be greater than 4.5 times of your qualifying income. Now, you must be also a Canadian citizen or permanent resident or a non-permanent resident authorized to work in Canada. You must have the minimum down payment requirements with traditional funds. This incentive is considered a second mortgage on your first home. First mortgage offered by the bank must be greater than 80% value of the property, and you would also need to purchase a mortgage loan insurance, which increase the size of your mortgage. Your home must be located in Canada, and you're using your home for yourself and cannot be used as an investment property. It's also interesting to note that the qualified properties can include duplexes, triplex, and fourplexes. So as long as you live in one of the units, you would be able to qualify up to fourplex. This can allow you to purchase a property to house hack as well. It is important to remember that this incentive comes with a price. The buyer must repay the incentive after 25 years or when the property is sold, whichever comes first. Repayment of the incentive is based on the property's fair market value at the time. Say you purchase a property for $500,000 and you receive a 5% incentive, the loan from CMHC, which is equivalent to $25,000. Your home value increases to $800,000 a few years later, and you save up enough to repay the government. You now have to pay back $800,000, the fair market value, times 5%, which is $40,000. You borrow $25,000, you repay $40,000. If you receive a 5% incentive, you repay 5% of the home's value at repayment. If you receive a 10% incentive from CMHC, you repay 10% of the house value at repayment. You will need an appraisal to determine the amount of repayment. Additionally, there are other costs involved that you should be prepared for as well. Well, there is one, extra appraisal cost. Typically, appraisals are done at the time when you purchase a property. With this program, you are also required to do a second appraisal on the property when you repay the government. Extra legal fees. You don't have one mortgage, you have two mortgages. The first one is with the bank, the second one is with the government. When you have two lenders, the closing can be more complicated. You may expect to see a higher legal fee for closing. Third expense is the mortgage insurance premium. One of the requirements is that you need to purchase mortgage insurance to qualify for the incentive, which is calculated based on the loan-to-value ratio. The mortgage insurance premium is added to the mortgage amount. You don't have to pay for it out of pocket at the time of closing. There are pros and cons participating in this program. You can have a smaller down payment saved up, but you have to share the upside with the government and you are incurring extra cost. Now we're on to the second incentive offered by the Government of Canada. The second incentive is the first-time land transfer tax credit. When you buy a home in Ontario, like everything else, you are required to pay tax, and one of the tax that you are required to pay is called land transfer tax. Literally, they really just transfer a title from one person, the previous owner, to your name, but they charge you an arm and a leg for land transfer tax. Eligible first-time home buyers are generally eligible for a refund on all or part of the tax up to a maximum of $4,000. So even if you're buying a home in Toronto, you're paying tens of thousands of dollars, but you can qualify for only up to $4,000. If you are buying a property less than $368,000, no land transfer tax is triggered at the time of closing at all. If you are buying a property greater than $368,000, you get a reduction of land transfer tax in the amount of $4,000 at the time of closing. When you consider buying your first home, make sure you confirm with your lawyer to take advantage of this tax credit. The credit will be reduced if your partner, who is also buying the home with you, is not a first-time home buyer. This credit is proportional to the interest acquired by the individuals who qualify for the refund. The third government program available is the home buyer's amount. If you are a first-time home buyer, you can claim up to $5,000 for the purchase of a qualifying home in the year if both of the following conditions apply. 1. You or your spouse or common law partner acquire a qualifying home. 2. You did not live in another home owned by you or your partner in the year of acquisition or in any of the 4 preceding years. The maximum amount you can claim is $5,000 between you and your spouse. The credit can be split between you and your spouse or common law partner's return. Home buyer's amount is considered a non-refundable tax credit. The $5,000 non-refundable tax credit coupled with 15% lowest federal tax rate result in a reduction of your taxes for approximately $750. If you're buying a home for a relative who's disabled, you may also be able to claim the home buyer's amount on your personal tax return. Okay, the fourth government program that I also took advantage of is the HBP plan. Essentially, you borrow from RSP with home buyer's plan. The home buyer's plan, also known as HBP, is a government program which allows you to withdraw from your registered retirement saving plans, RSPs, to buy or build a qualifying home. The key, though, is that you have to save inside your RSP to begin with. For those of you who have never contributed to RSP in the past, it may also be beneficial to make a contribution to your RSP up to a maximum of $35,000, assuming you have RSP contribution room available. When you make a contribution to RSP, you can claim a tax deduction on your personal tax return. For someone who's a full-time employee, generally speaking, you get a tax refund when you submit your personal tax return that year. When you purchase your home, you can leverage your home buyer's plan, withdraw the same $35,000 for the purpose of buying your first home. You're essentially borrowing against yourself and getting a tax deduction at the same time. As of March 2019, the HPP withdrawal limit is $35,000. If both you and your spouse are first-time home buyers, you can potentially get $70,000 toward your down payment. You have 30 days after closing of your first home to obtain the money through your financial institution. Like all incentives, you have to repay this one back too. You have up to 15 years. This one is a little bit longer, 15 years, starting from the third year after your withdrawal to pay back the funds you withdraw from your RSP. Minimum repayment is equal to the amount that you withdrew divided by 15 years. You can find the minimum repayment amount on the year-end notice of assessment issued by CRA after you file your personal tax return. Repayment is made by RSP contribution. All you need to do is you go to the bank and contribute to your RSP again. You can designate the amount that you intend for repayment on your personal tax returns. If you choose not to repay, the minimum repayment amount, whatever you have withdrawn divided by 15 years, is taken into income in that particular taxation year. You can read more on this here. It isn't easy for first-time home buyers to purchase their home these days. When I bought my home 13 years ago, I had to leverage most of the help I listed above. If you are a first-time home buyer, I do hope this video helps you buy your first home. If you like this video, make sure that you give us a thumbs up and subscribe to our channel. Until next time.